Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Good to have your company again here at AusBiz. Let's go across what happened overnight. Global equity markets shaking off concerns about the escalating conflict in the Middle East and have welcomed cooler than expected US inflation data, while positive US bank earnings also buoyed investors on Wall Street. The S&P 500 and Nasdaq advanced boosted by a rebound in chip shares also. Second quarter earnings season began with 5 of the big US banks reporting solid results off the back of surging trading revenue, with the SpaceX IPO raking in around $500 million in fees for the banks. Specifically, Goldman Sachs exceeded second quarter profit expectations as its deal making picked up and market volatility amid the US-Iran war boosted equity revenue to a record $7.4 billion, sending shares to an all-time high. JPMorgan posted the highest quarterly profit ever by a US bank, making a record $6 billion from equities trading alone, with Chief Executive Jamie Dimon saying it's getting as close to as good as it gets. We just don't know how long it's going to last. Bank of America also rose after delivering consensus-beating profits. However, Citigroup slid on concerns over expenses overshadowed its profit beat, while Wells Fargo also dropped. And IBM shares plummeted 25% after the company warned second quarter revenue would fall below estimates because of a shift in corporate spending from software to data center infrastructure. Well, US inflation slowed more than expected in June as energy prices retreated, with the CPI down 0.4% over the month, the first decline since April 2020. The pullback mostly reflecting an almost 6% drop in energy prices, and for the 12 months to June, inflation rose 3.5%, while core inflation was also softer than expected at 2.6% year on year. Meanwhile, Kevin Warsh made his first appearance before lawmakers as Fed chair, telling them that the members of our committee have no tolerance for persistently elevated inflation, and we share a resolute commitment to restoring price stability. He went on to say, if we get policy right, and we will, the inflation surge of the last 5 years will be a thing of the past. Well, US Treasury yields fell following the inflation data. The US 2-year down to 4.19%, the 10-year at 4.59%. Markets now pricing in a 20% chance the Fed funds rate will be hiked by 25 basis points at the next meeting at the end of this month, and a 70% chance of a hike by September. Australian 3-year government bond yield futures fell to 4.48%, the 10-year at 4.92%. The US dollar index was down around 1/3%. The Aussie has climbed to 69.8 US cents. Oil prices have continued rising after the US reimposed a naval blockade on Iran, which will reduce oil flows from the region through the Strait of Hormuz. However, President Trump walked back on his proposal to charge shipping a 20% fee in the Strait of Hormuz, saying he would instead seek investment deals with Gulf states. Brent futures rising more than 1.5% to settle close to $85 a barrel. Gold gained more than 2% after the softer than expected inflation data dampened expectations of Fed rate hikes. Spot gold up 1.6% at around $4,050 an ounce. Copper futures up more than 1%. Iron ore 1.5% higher to 102 US a tonne. And Bitcoin has surged to close to 65,000 US dollars. Let's get across all those market moves we've seen overnight. We are joined by Chief Market Strategist at Zacks Investment Research, John Blank. John, welcome back to you. Positive session, something for investors to be positive about. Let's start with an inflation number, and what we saw there was lower than expected. Look, I guess that is off mainly given those fuel prices have fallen. That could be about to change though.
Yeah, Andrew, let's just go through I got them right in front of me, the month on month from this Iran conflict going back 4 months. So it's 0.9% the first month, then we got 0.6%, 0.5%, and this month was minus 0.4%. But if you summarize all of that, Andrew, we're at basically 0.4 of a month on month run across the Strait of Hormuz conflict period. So 0.4 times 12 is 4.8% annualized. So close to a 5% inflation rate in a broad CPI or PCE context is way too high. I mean, the Fed cares about core PCE and not issues like this, but the diesel cost, the transport costs, the fertilizer cost, along with the gas at the pump cost is material for the United States economy. And strategic petroleum reserves in China and United States and Europe are basically, suppressing some of this, which is, also baked in. So now the 5% includes strategic petroleum reserve releases. So I think, people got a little bit heady today with these inflation numbers because the conflict is, if anything, further, on and 4 months in. So I would expect the Fed to be very concerned still about inflation with these numbers.
Well, indeed, because the markets, obviously, as I mentioned, the pricing there, they have pulled back on the expectations of a rate hike. Nonetheless, to your point, we seem as far away as ever from some sort of resolution in the Middle East. And of course, we have seen those oil prices surge well over 10% just over the past couple of days. So you would expect that to start, those inflationary pressures starting to feed back into the economy.
Absolutely.
All right.
Absolutely.
Now, that is obviously of great concern. Yet, as I mentioned, investors shrugging that off and also obviously buoyed about the beginning of earnings season, kicking off once again by the big banks. They're pretty impressive numbers, John.
Yeah, I mean, a lot of it was investment banking and trading revenue on the equity markets because of, they're kind of circular here because we had a huge run up in the equities markets across the board on these AI trades, and then they IPO'd in all these AI companies or, AI related companies into this. So, Jamie Dimon summarized it well. I mean, is this about as probably as good as it gets, and it's probably backward looking. So we got to keep in mind, having looked at the JPMorgan chart for share prices, it's been flat and very volatile for 9 or 10 months now. So in many ways, the banks are showing us that the top's in on equities for the financials anyways, and that they saw all this good news coming.
Meanwhile, I do want to point out IBM. That was brutal, wasn't it? And I guess reflects on what's going on more broadly there, as obviously mentioning there that spending shifting from software to data center infrastructure. I mean, 25% lower. That was heavily hit.
Yeah, Andrew, we'll get through some share talk today as usual, and we're going to find out this issue here with the difference between software, computing and the hardware component. And right now, the hardware component is sucking up all the revenue and all the dollars. So, but that doesn't mean it's gonna be always this way. We're going to have to see what this whole software story is, and that's what IBM said. People were holding off on paying for software because they wanted to buy all these servers and all these chips. But does that create a memory cycle downstream from here? Is that top in, or is there some type of over concern with this computer software pullback? So I think it's more murky than it appears, Andrew, and I think it's going to take a lot of time because the hype and the overselling of the ability of these vibe-coded consumer software groups at the AI level, the Claude level, the Open AI level, the Grok level is extreme. So I think there's just been so much hype and not enough data on the actual practices of these companies because they are IPO. We don't have their financials. We don't know how they price things. We're probably not going to know for 3 more quarters.
Well, speaking of valuations, let's go to the 3 stocks you've chosen today, beginning with what you're calling the most overvalued stock, ASE Technology. So what this is a provider of semiconductor manufacturing services.
Yeah, let's take a look at this stock. I mean, these test equipment, for chips. This is an insane story because it just appears out of nowhere back in 2025 to now. You could buy this stock. Let me pull it up here. When I looked at it, you could buy it for.
Oh, that's the wrong stock we've got there.
$10 a share, Andrew.
Yep.
Now you can buy it for $50 a share. So 5x, improvement in basically a year, with earnings that are going up about $1.40 a share this year. That's super rich, Andrew. That's a 48 PE, and that's why I put it at the top of my list because we're talking about whether we have bubble-like PEs and it's incorporating whether prices or earnings, but you start looking at actual given stocks, and we have a PE ratio of 48. That can go cut in half, Andrew, easily, and you're at 24, and that's still too rich. So that's why I call it the most overvalued one. It's insane, in my opinion, and I think we're going to see the big pullback in these types of names.
All right. So what do you make of the next one, Synopsys? Then that provides that software and hardware. What are you seeing there?
Yeah, this gets to my point I made earlier about IBM. And I mean, I pulled this up before IBM even reported, but you can see here the shares peaked on a software type company at $620 a share in mid 2024. Then they fell to $400 a share. So that is a huge 50% pullback or 35% pullback in these shares. Then it went all the way back to 600, like basically 4 months later. And then it's down again all the way back to 400. So I like the Synopsys story in this bubble framework because the software names are showing us how this can fall apart. It's going to fall apart in big volatile waves. It can be up and down moves like 35% up and then 35% down and then 35% back up again, 300. So we're going to have to get used to the idea, and this gets back to what we saw with JPMorgan's trading book, is this is a really good market for traders. But if you're trying to pick a top or be an investor in a market like this, you're probably going to get screwed.
All right, watch out for that. Thirdly, Cummins. So this is a designer, manufacturer, distributor of diesel and natural gas engines, which, look, you would consider there's some pressure on that business. Mind you, it's also in electrified power systems as well?
Yeah, so this is a typical story. We've talked about the double bubble. This is the industrials bubble I'm talking about. So Cummins, Andrew, is in Columbus, Indiana, I think, and they've been there for decades, generations. It's not a new company. They make power transmissions for automotive and truck, makers across the world, particularly the United States. And you could have bought these shares at $250 a share. Now they're charging $700 a share. P/E ratio of 23 doesn't sound that rich yet. So this is where we're at with this whole AI story. It's the power and the data centers that, supplying power or power equipment or construction of these data centers that's driving this Cummins story. But you got to ask yourself again, did the market get Cummins right at $280 a share 18 months ago? Or does the market have it right now at $700 a share? And again, my opinion when I look at these charts is it's just going to be a big run up. We're going to be in a climax top. We might even be in it right now, and it's going to have this effect. You see this in the Russell, you see this in the Dow, you see this in the NASDAQ. All these companies are starting to manifest these chart patterns that I just can't get my arms around and think anything other than this has just gotten out of control here in the last year and a half.
John, thanks so much for joining us on Zacks Investment Research.
You bet, Andrew.
All right, let's turn our attention to the local market just ahead of the open. Then we are expecting a positive start, up more than 0.5% off the back of the positive sentiment we saw overnight. Obviously, with investors encouraged by that inflation read out of the States, also some very strong bank earnings there, as we've just discussed. Mind you, oil prices have continued to rise. We'll get across all that in just a moment. Stay with us for the open.